Good morning, students. Today we will continue with the topic of Black-Scholes model. In the previous session, we discussed about the formulas, and in today's, let's start with a question on the same. So, question number 22 from the assignment, it says that from the following data for certain stock, find the value of a call option. So, first of all, the question is asking us to calculate the value of call option. We have studied the Black-Scholes model for both call and put option. We can apply anyways both the formulas, whichever way it is required in the question. In this, we are required to calculate the value of call option. Okay. So the price of stock now is 80 rupees, which is the spot price. Exercise price is also given as 75 rupees. Standard deviation of continuously compounded annual return is given as 0.40. This is also required, which is equal to V as per the formula. Maturity period, which is time, is equal to 6 months, is equal to P. And annual rate of interest 12, which is R percentage per annum. And they have given us some extra data also, which we will see how to interpret and utilize as and when we solve the question. So we are given e raised to the power and natural log of 1.06667. What is the value? So with these types of questions, we have to just simply take the formula, apply the formula, use the inputs and derive the output. This is a very easy and simple question, but yes, it involves a lot of calculation, correct? So we know that first of all, solution, value of a call option now students, in this, the question has not said that you have to use the Black-Scholes model, correct? But how have you identified that you need to use the Black-Scholes model? One is because in binomial model, there is no use of standard deviation, correct? In binomial model, all the other things are used: price, exercise price, maturity period, annual rate. Instead of standard deviation, what we are using there is the probability, correct? So had some question given us something on probability and not on standard deviation, we would have gone and applied the binomial model. But here, all the relevant data for Black-Scholes model is also given, including the standard deviation, correct? Hence, it got clicked that we have to apply Black-Scholes model only. So value of a call option using Black-Scholes model is given as VC's value of call. Now, we will just revise the formula also along with this. We said that it is spot price multiplied by ND1. So we said that for writing a call option, we need to buy the shares today, correct? That was the case. That was one of the case from the 4 cases that we have studied. So this is the purchase of the shares, correct? How many shares has to be purchased will be given by ND1, and at what price those are purchased is the spot price. This is the cash outflow. From that, we are going to reduce the cash inflow. The cash inflow is going to happen of the strike price, because we have written the call option. That means we have to purchase the share. Sorry, we have to sell the share. That means we will get the strike price equivalent amount. So present value of strike price was expressed like this: xe raised to the power minus rt multiplied by ND2, which is the probability that on expiry, the spot price will be higher than the strike price. This was ND2, correct? This is the present value of the strike price, which is we are going to realize, correct? This is spot price. This is also called as hedge ratio. Hedge ratio, why? Because This will tell us that to write one call option, how many shares we have to purchase. And this was the probability. Probability that on expiry, spot price is higher than strike price. Okay, students. So this is what the value of call option was using the Black-Scholes model. And in this D1 was, we have to write the formula once so that we can put the figures. So this was natural log, not the simple log. This was the natural log. Why natural log? Because the natural log has the base E and we have to apply that. S by X, which is spot price by exercise price, plus R plus standard deviation square divided by 2, mole multiplied by T, this whole divided by standard deviation underscore T, right? And D2 was D1 minus V under root T, correct? Now let us put the details in the formula. So first of all, we have to calculate D1. We have to calculate D1. For calculating D1, we need to calculate what is the natural log of S by X. So natural log of S by X is equal to natural log of what is the spot price? 80. What is the strike price? 75. So that means natural log of 80 by 75. 80 by 75, which is equal to natural log of, if we do 80 divided by 75, we get 1.00667. 1.0667. Okay. Now, students, if you see, we were given some additional data in the question. We are already given that IN 1.0067 is equal to this 0.0646. 0.0646. This is what the natural log of S by X is. Now, rest of the elements in D1 are very easy to be put. So, first of all, D1 is equal to 0.0646, correct? This is the natural log plus what is the R percentage? 0.12. Now, students, please note here we have to take the R percentage per annum, not multiplied with the period, because period we are multiplying in the end here. Okay, so this 12% has to be the annual percentage per annum. Okay, just make this point. Otherwise, there are chances to mistake here. So this is annual return percentage always, right? Then plus 0.40 square divided by 2. One more thing, students, if you see, we have converted all the percentages into decimals for the ease of calculation here, correct? Because if you put one thing in percentage, put one thing in decimal, then there might be some kind of a confusion how to solve it. But percentage can be expressed as decimal, so that is what we have also done. Multiplied by 6 by 12, because we are talking about 6 months of a maturity, correct? So as we said that always T is equal to 1 for 1 year, that means for 6 months, it would be 6 by 12, correct? This is 6 by 12 whole divided by what was the V under root T. So it was 0.40 under root 6 by 12. Okay. I hope that D1 formula is clear. And I would request all of you not to go into the derivation of this, not to because D1 and D2 are derived from a lot of other things which are beyond the scope. For example, Brownian motion movement and other things. So just remember what does the formula says. As we have already discussed here elaboratively, that what is the Black-Scholes model indicating, correct? So that if there is some requirement to tweak some element or the other, we know that what is the impact because of that. Okay, this is what called as D1. Now, if we solve this step by step, so what we will get is 0.0646 plus 0.12 plus 0.40 square divided by 2. If we open this, it will come as 0.08, and 6 by 12 is 0.5 divided by, and if we solve this, we will get 0.2828. These all calculations can be done very easily through calculator. Correct? This is what the D1 is coming out to be. This is D1. And finally, D1 is equal to, if we solve the numerator, it comes as 0.1646 divided by 0.2828. So which is equal to 0.5820. Okay, students. So D1 is 0.5820. Now let's park this value for a moment, because this D1 we will use from the normal distribution to calculate ND1, because ND1 is the normal distribution table value, taking D1 as this. Now what is D2? So D2 we know that is D1, which is 0.5820. We have put here as well. What is D2? D1 minus standard deviation under root T, minus standard deviation under root 2t means the same denominator that we have used in D1, correct? Because that is also standard deviation under root t, correct? So we will just do like this: 0.5820 minus 0.2828, which is further equal to which is further equal to 0.2992. So the D2 value is 0.2992. So D1 is 0.5820, D2 is 0.2992. Now, as a next step, we have to calculate ND1 and ND2 and just apply in the formula to get the result. Now, how to calculate ND1 and ND2? So in this question itself, we are given some of the number of standard deviation from mean and area to the left or right, which is one tail. This is what the standard normal distribution table is. Now, how can we conclude that this data is for the standard normal distribution? Because of this phrase, number of SD from mean. That means, can I rewrite this as x minus mean divided by standard deviation? Correct? So this will mean, because while understanding the concept, we studied that we have to calculate the z value, and z value is always calculated by reducing the mean and dividing it by the standard deviation. If we go back here, see, this was our z score, correct? Z score was that particular observation minus U, which is the mean, and totally divided by the standard deviation, correct? So this is the basic characteristic of a standard normal distribution table. Hence, reading out that, we came to know that this data is actually for the standard normal distribution table. At the value of 0.25, which is if x is equal to 0.25, then the area to the left or right one tail is equal to 0.4013. Now I'll explain this. So what does this mean is, if you see, we have also studied one tail, two tail. Yeah, this one. In this, what we studied is one tail means that it is only one side of the data. See, for our calculation in Black-Scholes model, we always use the cumulative probability. Why? Because cumulative probability is from left to right. Left to right. Okay. So this is needed because we need the left till right, which gives us the total probability for that event to happen, which can be used as ND1 and ND2 value always. Okay. We don't need any two tail, or we don't need any one tail. So this means that one tail means that it is only left or it is only right. It is not from left to right. So first of all, to convert that from left to right, we need to first take out the cumulative values. So number of SD from mean. This is useful for Z score, correct? 0.25, correct? 0.30. So 0.25 and 0.30 we are given. Then 0.55, 0.60. These also we are given. Now either left or right. So which is one tail is given as what values? If we see in the question, one tail is given as 0.4013, 0.3821, 0.3821, 0.2912, 0.2743, right? This is the one tail that is given. Now to convert this one tail to the cumulative probability, we need to do 1 minus one tail. This will give us the cumulative probability. Now the cumulative probability is what we have to use. $5987. Okay, this is how we have calculated is 1 minus 0.4013. 1 minus 0.4013 will give you 0.5987. Then 0.6179, which is 1 minus 0.3821. Then the next one is 1 minus 0.2912, which is actually 0.7088. And the third value is 1 minus 0.2743, which will give the value of 0.7257. So these are the respective cumulative probabilities we have calculated. Now students, all of you might be wondering why we have done 1 minus the one tail, because if you see this, okay, this is the standard normal distribution table. If let's say 0.25 appears to be here, correct? We need the total value till here, correct? What we are given is only one tail. One tail means that area to the right. Area to the right. Correct? So area to the right plus area from left to right will always be equal to 1, correct? Because the total probability is always equal to 1. Hence, we have done 1 minus area to the right to arrive at the area from left to right. Okay. Similarly, if we talk about the area to the left, so what we have already told is that this normal distribution distributes the data evenly, correct? Because we said that half of this data to the left will be 0.5, half of the data to the right will also be 0.5, 50%. So if 0.25 is on the line here, correct? So whatever area to the right will be, the same area, although our observation is here, correct? 0.25, our observation is actually here, but there is a mirror observation that will also, so these two data points will be equal, correct? This is called as left tail. This is called as right tail. So this, if let's say it is 0. How much? For example, we were given in the question 0.4013, right? 4013. This is all. This would also be 0.4013, correct? But we have to find out this area till here, which is still our observation. Hence, we have done 1 minus this, correct? Now, what is the value that we have to find? ND1 is what value? N. D1 is 0.5820. Now, do we know exactly what is the value of 0.5820? No. We are given two different values from the different ranges, 0.55 and 0.60. We will use both of them, apply the interpolation technique, and arrive at the middle value. So 0.55 is actually 0.7088 and 0.60 is actually 0.7257. This is what the cumulative value is. Now, using interpolation technique, N 0.5820 is equal to the lower value, correct? 0.7088 plus the difference in the values, correct? Which is the upper minus lower value, 0.7257 minus 0.7088. This is the total step that difference between 0.60 and this whole divided by the observation, which is 0.60 minus 0.55, correct? For this difference of 0.60 minus 0.55, the value difference will be 0.7257 minus 0.7088, correct? But if this is the difference for 5 points, correct? This 60 minus 55, if this is the difference for 5 points, then what is the difference from the required value, which is 0.5820 minus 0.55? Simple. This is a very simple interpolation technique. Yeah. It's a very simple interpolation technique that we have used. So that means N is 0.5820 is equal to, if we solve all this, 7197 is what we will get as an answer. Okay. So till now we have calculated the ND1. Now calculating the ND2. So ND2 was how much? 0.2992. This was the ND2, correct? D2 was equal to 0.2992, which is equal to 0.5987. Now we have to use the interpolation From which and which values here? So 0.25 and 0.30. 0.25, the cumulative probability was 0.5987 and this was 0.6179. Correct? So 0.25 had this and 0.30 have this. Now using these two values, we will again apply the interpolation technique. So 0.6179 minus 0.5987, this is the total difference, whole divided by 0.30 minus 0.25, correct? Multiplying it with 0.2992 minus, because 2992 is the value for which we need, minus 0.25, correct, which is the lower observation. So hence, using this n, 0.2992 comes as 0.6176. This is again using the interpolation technique. So ND1 and ND2 are calculated. Now we are left with nothing but calculating the value of call option itself. So the spot price is 80 multiplied by ND1 was what value? ND1 was value this 0.7197 minus 75 is the present, 75 is the strike price for which we have to calculate the present value, multiplied by e raised to the power RT. What is R is 0.12 minus 0.12 multiplied by 0.5, which is 6 by 12. So why we are doing 0.5? It is for 6 months. 6 months means 0.5. And this whole multiplied by ND2, which is 0.6176. Okay. 0.6176 is the value. Now, value of call option is equal to, this we solve is coming out to be 57.57 minus 75 divided by, if, so what is the property of anything raised to the power anything is, if it is in minus, so we can take it to the denominator of, or it is in denominator, we can take it to the numerator by putting a minus sign, correct? So in this, I am taking it to the denominator and removing the minus sign automatically, because if it comes to the denominator, the minus sign will not be there. 0.6176, so which is equal to 57.57 minus 75. Now students, if you see this value, e raised to the power 0.12 and 0.5 is also given in the question. See, this exact value is given in the question, which is 1.062. Multiplied by 0.6176. Value of call option is equal to 57.57 minus 43.62. So which is finally is equal to 13.95. So this is what the premium for a call option should be as per the Black-Scholes model. So this entire question was very much extensive in terms of the calculation, but the steps are very easy. There is nothing, there is no ambiguity in the steps. We know how to apply it, and then we can apply it and quickly solve it. The only thing is we need to read out the data and see what all things are given to be fit into our final solution. Now, for example, this number of SD from mean, which is the Z score, is actually nothing but used in the standard normal distribution, correct? Standard normal table. Okay, we will now move forward with the next concept. So the next concept is actually the put call parity theory. Now, just to recap for 2 minutes, till now what we have studied is in derivatives, we have studied forwards, first of all, we have studied futures, and then we have studied options. Okay. For all three of them, we have understood the three common things. One is what is the actual concept, correct? Second thing is how does the trading, or let's say how does the hedging happens. I can use the word hedging because hedging is used to protect against from the losses in future. And how can anyone do a speculation, correct? How are we going to do the valuation? Because for doing the hedging, speculation, or getting the arbitrage profit also, you need to understand how the valuation principles are working, correct? So these are some of the common concepts that we have studied across, correct? This is what the entire derivatives majorly is. Apart from that, now there is one more thing which we have to study is actually put call parity theory. Now, what does this put call parity theory means? First of all, this is designed for an option because put option, call option are in options concepts itself, correct? So there is a put call parity theory. Now, what does it say is that now we have taken some 4 cases in our previous session. Just a second. I am just going to those cases only. Yeah, these 4 cases were there, right? So we studied that for options, there are 4 types of situations which we have bifurcated that what action or what position are we taking in options market and what action are we doing in the spot market. So in this, we have already used case number 2 and case number 4, correct? For valuing the call option under Black-Scholes model and valuing the put option under the Black-Scholes model. So this was also done and this was also done. Now we will use the balance 2 cases for the put call parity theory. So this long call option, we are going to use put call parity theory. So what does we said in the long call option was that if we are doing any long call, that means we are purchasing the right to buy. That means we have to pay the amount equivalent to the strike price on expiry while exercising the option. That means we said that today only we will invest the present value of strike price and we will keep it so that once on maturity we get the strike price equivalent of amount and we will pay the amount for purchasing the security, correct? And then the third case was if we are doing the long of put option, that means we are purchasing the put option, that is the right to sell. For that, we have to purchase a share today. Then only we will be able to sell it on the expiry date, correct? So this also we are going to use under put call parity theory. Now let us go to the concept. Yes. So under put call parity theory, let us build our situation through this kind of a example. So for example, R is equal to 20 percentage. I'm just assuming the numbers now so that it will be easy for us to calculate. Strike price. R is what the annual rate of return, correct? Strike price. is equal to 180, for example, and the spot price is equal to 150. Okay. And for example, T is equal to 1 year. We are not complicating the situation by introducing 2 months, 3 months, 4 months. We're just putting T is equal to 1, which is for 1 year. Correct? Sorry. So now just we have to think it from the two angles. Correct? One from the purchasing a put option and one is from the purchasing a call option. That is what the case number 1 and case number 3 were. Correct? So first of all, if we are going to purchase a purchase put option, correct, which is a long put option, that case that we have discussed. So if you are going to purchase one put option, and I am assuming that the put option premium is rupees 10. Okay. Value of put is equal to 10. Value of call, I am assuming it to be 15, just to bifurcate and differentiate. Okay. So now if a value of a put option is 10, that means the premium that any investor will have to pay for purchasing a put option is rupees 10. Now, what additional thing he has to do in case he's purchasing the put option? That means he's purchasing the right to sell. If he's purchasing the right to sell, now in case he's doing that, he need to have that share also with him, because on expiry date, once he's going to exercise the option of on selling the goods, on selling the share, then he need to have that share to sell it. Correct? So that means spot price, he has to purchase a share and keep at spot price, which is 150 rupees. So 150 rupees he will invest today, and 10 rupees he will invest in the put option. 150 for purchasing the share and 10 rupees for purchasing a put option. And then his one of the portfolio is formed, for which the initial cash outflow will be 160. Initial cash outflow is equal to 160. Right? Now, this is what the, let's say, portfolio 1 or investor 1 will do. We are talking about the investor 1 here. This is our investor 1. Okay. Now imagine there is another investor who is investor 2. What he does is he purchases a call option. Purchase call option. Now, if he's purchasing a call option, first of all, he has to give 15 rupees, correct? Because the 15 rupees is the call option premium that I have assumed here. Now, the moment he's purchased a call option at 15 rupees, what he has to make sure? He has to make sure that in case he has purchased the call option, which is the right to buy, and he needs to exercise this at the time of expiry, then he need to pay the amount equivalent to the strike price. That means he has to invest the present value of strike price today, so that on expiry he get the maturity proceeds of the strike price equivalent amount, and that he uses to purchase the equity share. And this is what in our case also we have studied: invest present value of strike price. So the strike price is how much? 180 rupees. What is the present value? 1 divided by 1 plus 20 percentage. And time is equal to already 1. So there is no need to prorate the percentage. Correct? So 180 multiplied by 1 plus 20 percentage. So this will give us the present value of strike price, which is equal to 150. Correct? 180 divided by 1.2 is equal to 150. And hence the total output or the total cash outflow initially is 165. This is what investor 2 has done. So first of all, for proving the put call parity theory, okay, we have built two scenarios, or two investors have acted upon differently. Investor 1 says that I will purchase a put option and I will purchase a equity on the spot price. Second investor says, no, I will purchase a call option and I will invest the present value of strike price, so that once the time term comes to exercise the option, I will use the present value of strike price amount to purchase the share. So this is the initial discussion that we have done. Now let's go to the subsequent cash flows. Subsequent cash flows. Okay. Now under subsequent cash flow, students, please note, if the price comes as 200, we will take different scenarios. If the actual spot price comes as 200, correct? We have said now that there are two types of options: value of put option, value of call option. Strike price is 180, current spot price is 150. So we are saying that if actual price on expiry, I am talking about now on expiry, it comes out to as 200 rupees, then let us again calculate the cash flows from both the angles, which is the put option holder and the call option holder. Can I write here that he is a put option holder, investor 1, and investor 2 is the call option holder, correct? So on expiry, if the put option holder, how he will say is, what is the strike price of the put option? 180 rupees. If the strike price is 180 rupees, actual spot price has gone to 200 rupees. That means the put option is totally out of the money, because the spot price is higher than the strike price. That means the put option is of no use. Correct? So the put option will fetch nothing. It is out of the money. Out of the money. Correct? This is what the put option will mean. On the other hand, for the spot holding, he is holding one share. That one share, he can easily sell it now at 200 rupees, correct? Sale proceeds is equal to 200 rupees. This is the total cash inflow, which is 200 rupees. This is again for investor number 1. So investor number 1 will again expect a cash inflow of 200 rupees if the price comes as 200 rupees on expiry. Now let us understand from the call option. So the call option holder, is this a benefit for call option holder? Yes, because now it is in the money. In the money. Why? Because the price on expiry is 200 and the strike price is 180. That means there is a 20 rupees benefit. There is a 20 rupees benefit here. Correct? Which is nothing but the difference between the spot price on expiry minus the exercise price. And he will get the maturity proceeds as well. Maturity proceeds, he will get how much? 150 is what he invested on the 20% per annum kind of a rate. So he will get 180 rupees. ultimately on settlement, call option also is settled on a net basis, and this amount also comes to him on a 100% basis. Correct. So 200 rupees is again the total cash inflow here as well. Correct. This is for investor 2. Okay, students. So this is for investor 2. Now, what if the price comes as 100? So first case we have taken the price comes as 200. Now the second case we are taking as price comes as 100 on expiry. Okay. If the price comes as 100 on expiry, that means now the put option holder will be benefited. Why? Because strike price is 180, the spot price has come down. That means 80 rupees he will gain out of this option. The put option is now in the money. In the money, which will give him 80 rupees. What he's going to do is he will sell the stock at the price of 100 rupees. This will give him 180 rupees totally. And similarly for call option, the option has expired and it is out of the money now. Out of the money. And he will realize the maturity value of the investment, which is equal to 180 rupees. Correct? This will not change. Maturity will be same only. So hence here also it is 180. So whichever way you do, whatever price comes out to be for both the investors, the future cash flow is same. Correct? This is also 180, this is also 180, this is also 200, this is also 200. So don't you think that their initial cash flow should also be same? Because why will an investor invest in second scenario? He will always invest 160 rupees in this and he will get the same cash flow that he would have got by investing 165. So don't you think basis the demand and supply, market forces will bring investor 1 cash outflow as equal to the investor 2 cash outflow? Because ultimately, subsequently, both of them will get the same amount. Correct? That means the initial amount of investment will also be equal. That means the demand of investor 1 portfolio would be higher, and demand, or I can say the supply, since the demand is higher here for investor 1 portfolio, the price will also be higher. That means simply this put option instead of 10 will become 12 rupees. And since this investor 2 is non-viable option, so the supply will increase and the demand will decrease. Since the demand will decrease, the supply will increase, and hence it will bring down the value of call option to somewhere around 12 rupees, so that both of them are at 162 and 162. This is what I'm trying to explain. Through demand and supply forces, both the portfolios will be equal, and this is what the put call parity theory says. As per put call parity theory, value of put option plus spot price is equal to value of call option plus present value of strike price. This is spot price. These two, LHS is equal to the investor 1 initial cash flow. RHS is also equal to the investor 2 initial cash flow. So this is investor 1 initial cash flows, and this is investor 2. This I'm taking from my example so that it correlates there. So investor 2 initial cash flows. This entire thing. And here also this entire LHS. Okay. So simply this is case. These are the two different cases that we have already studied in our previous session. But the link is here. Ultimately, subsequently, whatever price will come, both of them will give you the same cash flow. If both of them are giving same cash flow in future, the today's value should also be equal. This is just the very simple principle that we are carrying here. Students, I cannot see any questions or any doubts. Please post anything if you have any question or any doubt related to the derivatives concepts that we are studying. Okay. Please ask questions wherever you feel you are stuck. Okay, students. So this is what the put call parity theory is. Okay. We will attempt one question, which is the last question, I think, in the assignment. Yes. And then we will cover some theoretical concepts. So this is a very interesting question number 23rd. Okay, Naveen, thank you. So question number 23rd, it says that the shares of TIC Limited are currently priced as 415. Okay, now this is a very good question. This will test the Black-Scholes model, put call parity theory, all the concepts put together, the dividend adjustment in the spot price, all the things it will test. So let's attempt this question and then let us see. The shares of TIC Limited are currently priced at 415 and call option exercisable in 3 months time has a exercise rate of 400. So 400 is the strike price, T is equal to 3 months, and the spot price is 415. The risk-free interest rate is 5% per annum, which is R, and the standard deviation is 22%. So the standard deviation is also given, R given, T given, exercise price, and the spot price, all the things are given. Based on the assumption that TIC Limited is not going to declare any dividend over the next 3 months, what is the relevance of this line actually? If you see, the relevance of this line is that you don't need, for all the derivatives valuation purposes, you don't need to adjust dividend in the spot price, correct? Because if in the next 3 months there is no dividend, we can take this 415 as the price as is, correct? If there is a payment of dividend if within these 3 months, that we need to adjust under this. And in the next line, it is asking, is the option worth buying for rupees 25? So they have given that 25 is currently the option price. You tell us whether it is worth buying at 25. Now, students, we know basis the principles of overpriced, underpriced, what to be bought and what to be sold. If something is underpriced, then we will buy it. If something is overpriced, then we will sell it. Now, how do we come to know that something is underpriced? So the underpriced, we will come to know once we know that what is the theoretical minimum value. And the theoretical minimum value need to be calculated here using the Black-Scholes model. Correct? First, we have to derive that what is the theoretical value coming out of this value of call option. And that we have to compare with 25 to give a final conclusion whether it is worth buying or it is worth selling. Correct? So A part, using Black-Scholes model, write the formula as many times as possible, correct? so that you all are able to remember this. Although the logic is same. So if we say that value of call option is equal to spot price multiplied by ND1 minus strike price present value multiplied by ND2. Simple. Correct? Is the value of call option. Now, one more thing which I have to tell all of you here is, if you all can add here these 2-3 data points, I will tell you even how to calculate the natural log as well. It's very easy. There is a calculating trick. But as of now, I'm just giving you all these values, 0.03681. Okay. Then log of 0.95 is equal to minus 0.05129 and e raised to the power 0.05 multiplied by 0.25 is equal to 1.012578, and last is e raised to the power 0.05 multiplied by 2 by 12 is equal to 1.0083. Now, students, please note these 1, 2, 3, and 4 values that should be part of this question, but are not there. So these just to make correct. Although I will tell you how to calculate the natural log also, correct? In case the value is not given. Although 99.9% you will be given a direction either in terms of the value or through a table. So don't worry for that thing, because here the application is more important. Okay. So the value of call option is what we have to determine, correct? All the things are given to us. We will just simply put, first of all, let us calculate the D1. I'm skipping the formula writing, but it's better if you write the formula for D1 as well. So D1 is equal to natural log of spot price divided by the strike price. Strike price is 400, correct? Plus 5%, which is the annual rate of return. Again, this is the annual rate, correct? Not you don't have to prorate this rate here only, correct? Then 22% raised to the power 2 divided by 2 multiplied by 3 by 12, which is the time. These both percentages can be converted into the decimals easily for the purpose of calculation. This whole divided by 0.22, which is the volatility rate under root of 3 by 12. Correct? This is D1. Now, if you see this, there is a natural log of this we have to calculate, which is 415 divided by 400. So the natural log of 1.0375, how it can be calculated using a calculator. In case using a calculator trick, correct? Most of you would be knowing this also. So just for the sake of repeating, what I'm putting here is, first of all, I'm just putting the steps here so that we all know. So first of all, we have to take 2.7183. Just remember this, because this is the exponential function. Remember this E value. So E is always constant. If you see, E is always constant and the value is 2.7183. And why we are taking E? Because natural log is a reverse of exponential function, correct? So hence, first of all, we will take E, which is 2.7183. Okay, we have to do a square root 12 times. Now, students, if you see on your calculator, there is a square root option already, correct? So press that square root 12 times after putting 2.7183. Do this, and then whatever value comes out, minus 1 from that. Okay, and then finally, whatever is the value, just store it in M plus, correct, which is the memory. So you can just store it into the memory, and then finally take the value now. So this step you have done using 2.7183, correct? Now as a second step, take the value for which the natural log has to be calculated. Take value, in this case it is 1.0375. 1.0375. So take input from natural log, correct, for which the natural log we have to find. Again do 12 times square root of this value, again do -1, and finally whatever this value comes out to be, divide this by memory recall, MRC. Whatever you have stored in the MRC, you just divide it by the MRC, and whatever the final value will come, that is the natural log of 1.0375. Okay, very easy, very simple. We have to just do the same steps first with 2.7183, and then whatever is the final outcome, store it in the memory, then take the exact input for which you are going to do the natural log, do the same steps, finally whatever is the value, divided by the memory recall. Okay, so I'm skipping this part. The process is very clear. So the D1, since we are given this in the question, I have just asked you to mention it, so we will write it. D1 is equal to 0.03681, which is the natural log result of 1.0375, correct? 1.0375 is equal to 0.03681, correct? Plus, if you solve the other bracket, it will come as 0.1855. This whole divided by 0.11 if we solve this. So this comes as 0.50327. Okay. This is called as D1, 0.50327. Similarly, D2 will be calculated as 0.50327 minus 0.11, which is equal to 0.39327. This is called as D2, correct, which is D1 minus the denominator of D1, correct, which is V under root T. Now, ND1 is equal to N 0.50327. Now, here also we would have to apply the interpolation technique, because we don't know for these 5 decimal, after decimal, these 5 figures, what is the N value. So let us do one thing. Let us take out the value of 0.51 and 0.5 from the standard normal distribution table and use the interpolation technique. Now, if you need to refer the standard normal distribution table, see, this is 0.5, correct? So 0.51 is this, correct? And 0.50 is this value. Okay, and just before reading the data from here, just read the top. It says that table values represent area to the left of Z-score, which is what we need. This is called as cumulative area, correct? This is what we also need actually. If it was one tail or two tail, we need to convert it as per the process that we have discussed, correct? So 0.50 as we just now have seen is, what is the value? 0.69146, and this will be 0.69497, correct? Now, using interpolation technique, Okay, using interpolation technique. So what is the lower value? 0.69146 plus the difference between these two, 69497 minus 69146 whole divided by the difference in the observation, correct? This multiplied by 0.50327 minus. This is the actually Z value for which we are going to calculate the amount, correct? And then minus 0.50. Hence, ND1 is equal to 0.6928. This is called as ND1. Just using the interpolation technique, we have calculated the ND1. Ambika, you have posted, sir, market demand. Can you please complete the question? Maybe I have not got the complete question. Then similarly, ND2. ND2 is equal to N 0.39327. Correct? This is what we have to find out. So in this case, we will take a lower value of 0.39 and higher value of 0.40, and then we will do the interpolation technique. Now again, going back to the standard normal distribution table, correct? Standard normal distribution table, you can easily find it on internet also, correct? So what is the value that we are looking for? 0.39 and 0.40. So 0.3 and 9 is actually this value, the last value, which I'm just circling here. And 0.40 is actually this value, 6.554 and 6.6513173. Okay, so 0.39 is equal to 0.65173, 0.65542. Correct? Again, we will use the interpolation technique here. Using interpolation technique. What is the lower value? 0. We will always start with the lower value, 615173 plus the difference between these two, correct? 0.65542 minus 0.65173, this whole divided by 0.40 minus 0.39, this multiplied by the difference of the observation minus the lower value. 0.39327 minus 0.39 itself. So hence the ND2 is equal to 0.6529. This is what the ND2 is. ND1 we have already calculated. So now let us just apply the formula. So the value of call option is equal to 415, which is the spot price multiplied by ND1 value, which is 0.6928 minus 400 is the spot price. The present value is divided by e raised to the power RT. So the R is equal to 5% and time is equal to 3 by 12. So 3 by 12 can be write as 0.25. That should be okay. And this whole multiplied by 0.6529, which is the ND2 value just we have calculated. Yes, Ambika, you are right. Market demand of option equals the investment of investor 1 and investor 2. That is right, actually, Ambika. Because of that only, the put call parity theory relationship is also established. Now, students, if you see, this value is also, I have already asked you to make a note of it, because in the previous question, if you see, it was mentioned. And this also it is there. So which is 1.012578. So the value of call option is equal to, if we solve this, we will get 287.512 minus 400 divided by, what is the e raised to the power 0.05 multiplied by 0.25 given as 1.012578 multiplied by 0.6529. Correct, students? So the value of call option with this. So the value of call option comes out to be 29.60. This is the value of call option is coming out to be as per the Black-Scholes model. This is also called as theoretical minimum value, because we have calculated it through the valuation procedures. Now, actually, it is available at 25 rupees in the open market, something which has a value of 29.6 as per all the data that we are given. So what do you suggest? It is overpriced, it is underpriced, or what? It is definitely underpriced, because in market it is available at 25. So you will go and purchase this, correct? So since the value of call option as per BSM is higher than rupees 25, hence we recommend to purchase the option at rupees 25, since it is under priced. The actual value is actually lesser than what it should be. Okay, student. So hence it gives us that indication that we should purchase these options, because the minimum value is actually higher than the current price that is running in the market. Okay, student. So this is the first part of the question. So it was asking us to calculate this. Yeah. A part is done. Now B part, calculate the value of aforesaid call option based on Black-Scholes valuation model if the current price is considered as 380. Now this is another part where they are asking us to calculate the current price instead of 415. So Ambika is saying 1.012578, how we got it. So Ambika, as I have in the start, before starting this question, I have mentioned to note these values actually that are not part of the question, but still those will be given in the question. Okay. So from there we have made use of the e-rupees. Now in the B part, it is asking us to calculate the valuation again, but in case we take the spot price as 380. Now students, directionally can all of you think that where the premium will go? See, earlier the spot price was how much? 415. Now they have reduced the spot price. Reducing spot price will have a reduction effect on the value of call option also. The premium will be reduced, correct? Because in case the spot price is going higher and higher, then only the premium will also increase. This is what the D1 and D2 is also happening there. Using the D1 and D2, the same logic applies here as well. Yesterday we studied now the natural log spot price divided by exercise price. In case it goes up, this will result into higher D1, which will result into higher ND1, and which will further result into higher value of call option. Correct? And similarly, lower spot price will result into lower D1, lower ND1, and lower valuation. So if it is higher, so all the things will have a higher impact. Correct? Now, let us just calculate D1 here. D1 is equal to natural log of 380 divided by 400. Correct? Instead of 415, now we are taking 380 plus. The rest all data remains same. 5%, 22% raised to the power 2 divided by 2 multiplied by 3 by 12. This whole divided by 0.22 and square root of 3 by 12. Correct? This is D1. Now, if we calculate all these things, now log of 380 by 400 is actually this value. Log of 380 by 400 is actually 0.95, correct? If you do 380 divided by 400, this is equal to 0.95, which is given as this, minus 0.05129. So D1 is equal to minus 0.05129, correct? This is the log 380 by 400 value, plus, if we solve this part of the equation, 0.01855, this whole divided by 0.11. Correct? So this gives us the negative value of D1, 0.297636. This is the D1 value, and the D2 value will be D1 minus 0.11, which is equal to minus 0.297636 minus 0.11. So this is equal to minus 0.407636. Correct? This is actually D2, and this is actually D1. Correct? Now we have to calculate the D1 and D2 values using the interpolation techniques again. Now, first of all, N D1 is equal to N minus 0.297636. N D2 is equal to N minus 0.407636. Okay, students, so this we have to find out. I'm not going into using the interpolation technique again because that will prolong the entire thing. You just try this part at home using the interpolation technique. So just like we have a positive table of standard normal distribution, we have negative table also, this one. So from this, you find out the negative value of the for the particular range that will be used in ND1 and ND2 using table. I'm just directly putting the number here. Okay. So the ND1 will be equal to 0.3830. Okay. And ND2 is equal to 0.3418. Okay. This is ND1 and ND2. Now just apply the formula 380 spot price multiplied by 0.3830. Now students, here only you can see earlier it was 415, correct? Now it is 380, the reduced spot price. That will have an impact of reducing the value of call option in totality. This minus 400 divided by 1.012578, this will remain same, correct? The present value of strike price will remain same, the denominator as well as the numerator, multiplied by 0.3418. Correct? So this will give us the value of call option as equal to 10.52. So this 10.52 is actually the value of call option if we reduce the strike price from 415 to 380. Now in this case, the option is not worth buying because the option that is available at 25 rupees. However, the actual value is only 10 rupees. If you have this option, kindly sell it because this is overpriced. Okay. Although this is not asked from the question, but we are just going one step forward and trying to understand the implication. Now, what is the next part? So A part done and B part done. Now the C part is what would be the worth of put option if the current price is considered as 380. So they are saying no, we will go ahead with the 380 kind of a price, because now let us evaluate that what is the put option, because put option should be higherly valued, correct? It should be properly valued. Why? Because the put option will be in the money. 380 spot price, 4115 strike price. It will be, sorry, 400 is the strike price. It will be in the money. So hence, let's evaluate what is the option, what is the price of the put option. Now there are two ways here, students. One is to apply the Black-Scholes model formula for valuation of a put option, or the easier way would be to apply the put call parity theory, because under put call parity theory, we have already calculated the value of call option as 10.52. Rest two numbers are there, and the third number we have to find. So let us see how we can use the put call parity theory here. Using sorry. Using put call parity theory. Okay. If we are using the put call parity theory, then we already know that value of put plus spot price is equal to value of call plus present value of strike price. Correct? Now value of put is what we have to find, plus spot price. They have told that how much we have to take is 380. Value of call basis the previous step, because they are saying you have to go ahead with the 380 spot price. 380 spot price means it is 10.52 plus present value of strike price. Strike price is what? 400. Present value will be e raised to the power 0.05 multiplied by 0.25. Correct? So the value of put is equal to plus 380 is equal to 10.52 plus 400. Now this value is already given in the question, correct? Which is 1.012578. 1.012578. If you solve this equation, the value of put is equal to 25.58. Now, students, please see the value of put is coming out to be 25.58. However, the value of call was only 10.52. Why there is so much of gap? The reason being, currently the spot price is lesser than the exercise price. Hence, the people are looking towards put option as a more viable option compared to the call option, because put option will fetch them better returns compared to call option, as currently the strike price is higher and the spot price is lower. Correct? Since spot price is lesser than the strike price, hence put option is more lucrative. Okay, students. So this is the use of put call parity theory. So out of these four things, now you can understand that what has to be done. So basically, out of these four variables, if three of them you know, the fourth one you can calculate. Correct? If three of them you know, fourth one you can calculate. Mostly it is used to calculate the value of put option or value of call option, given that we know what is the other put or other call option value. Spot price and present value of strike price is already given. Correct? Now let us go to the last part. This question is also actually very bulky in the sense that it covers or it protects all the things into the entire thing. So the entire options concept, be it put or be it call, only for the Black-Scholes model you can revise it. This is the formula. Even the put call parity theory as well. So the last point, it says that if TIC Limited share price presently is taken as 408, now they are again revising the spot price. Earlier it was 415. Then for B and C they have taken 380. Now for the D part they are taking it as 408. So the spot price is taken as 408 and a dividend of rupees 10 is expected to be paid in the 2 months time. That means what is the time limit for the option? It is 3 months. Within 3 months, if there is a dividend, that has to be adjusted in the spot price. Now the fourth part is testing you on the dividend adjustment, and the dividend has to be paid 2 months time, then calculate the value of call option. So students, it is again very easy only. So if we go to the D part, okay, what does the D part says is, this is our 2 months and this is our 3 months. So 0, 2 months, 3 months. Okay. So 3 months is the expiry of the contract. 2 months dividend payout is expected. So what we can do is we can actually take a present value and reduce from spot price. Correct? The moment we do the present value and reduce it from the spot price, we can understand that what is the revised spot price, and we will use that in our Black-Scholes model. So revised spot price will be used in our Black-Scholes model. Now, I'm just calculating the present value of dividend. What is the absolute dividend that needs to be paid is rupees 10, I guess, right? Is rupees 10, correct? 10 divided by e raised to the power. What is the interest rate? 0.05 multiplied by 2 upon 12. Okay, Namita, I will check and we will come back on this query on the handwritten notes. Okay. This is the dividend's present value. Okay. Now, for calculating this, 10 divided by this e raised to the power 0.05 and multiplied by 2 by 12 will be calculated how? Is actually given in the question. I have this is one of the 4 points I have put here, which is this. So this is equal to 1.0083. 1.0083. Okay. This should be given in the question. Hence, I have asked you to note these points. Correct. So the present value of dividend is equal to, if you divide 10 by this 1.0083, then you will get 9.917. Hence, the adjusted spot price is equal to 408 minus 9.917, correct? Which is equal to 398.083. This is the adjusted spot price. 398.083. Because from the exact spot price, we have reduced the present value of dividend. Now, this spot price will be used in D1 and D2 and the Black-Scholes model to calculate the value of call option. So that part we will solve after the break. Now let us break for 10 minutes and then we will again reconvene at 8:44. Welcome back, students. So we were discussing the question number 23rd, last part. In that, we have calculated the spot price by reducing the present value of dividend. We call it as adjusted spot price. Using this adjusted spot price as a next part, we have to calculate the value using the Black-Scholes model. Now, what value we have to calculate, whether value of call or value of put? Let us go back and check it once. They are saying then calculate the value of call option. Correct? Using Black-Scholes model again. First, we have to calculate the D1. D1 is log of 398.083 divided by 400 plus 0.05 plus 0.22 square divided by 2 multiplied by 0.25 whole divided by 0.22 under root of 0.25. Okay. So the log of this, if we calculate using the same principle, or even if it would be given in the question, so I'm just putting the direct values here, minus 0.00480 plus 0.01855 whole divided by 0.11 is equal to 0.125. Hence, D2 is equal to 0.125 minus 0.11, which is equal to 0.015. So ND1 is equal to N, 0.125 is equal to 0.5498, and ND2 is equal to N 0.015, which is equal to 0.5060. I have just taken the exact values ND1, ND2 again. The part of looking this value from the distribution table and doing the interpolation technique, please do try at home separately, correct? Because in the interest of time, I'm skipping that. We have to cover other things as well. Then the value of call option is equal to 398.083. This is the adjusted spot price that we have to use, correct? Multiplied by 0.5498 minus present value of strike price. This is again the same value only, 0.12578 multiplied by 0.5060. This is actually the value of call option. $18.98. So students, if you see at different prices, we have calculated the value of call option. Here it was 29 point something. Yeah, it was 29.60. At 380, it was 10.52. And 398, which is the adjusted price after dividend, it is 18.98. So if we see, students, it is having a direct correlation with the strike price. Still there is some value. Spot price is lower than the strike price. Still it is giving you some value. And if it is further lower, the value is lower, but still it is giving you some value. So it depends where the strike price is. Now, in this, what I'm trying to say is there are a lot of factors that determine the pricing here, correct? This is the pricing, 29.6, 10.52, 18.98. There are a lot of factors apart from the spot price that impacts the valuation. What are those factors? Now, those factors are nothing but all the inputs that goes into the value of a Black-Scholes model. What are those inputs? The first of all is spot price. Second is time. Third is rate of return, percentage. Fourth is volatility, which is equal to V. Correct? So these are the factors that actually changes. If these changes, the valuation will also change. Correct, students? So with this, we have completed the question number 23. Okay, whatever is the part of the question number 23 that we have completed. Now let us go and do some of the theoretical part. And the most of the practical part is completed now. We will see if something is left. Yes. So first of all, let us go to the concept of Greeks. Now, students, please listen to these concepts very carefully. Although these are theoretical in nature, but there are chances that the thought process can be tested around this. Greeks. What are these Greeks actually? These Greeks are factors affecting the prices. Correct? So these are the factors affecting the prices. Now, what are those factors affecting the prices? Just now we have seen there are these four factors that affect the prices. And the prices of what? We are talking about options. Sorry. Now, the first Greek that we have to study is delta. Now, what is delta? Delta is for a call option and put option. We will study it for both. Okay. This is the call option. And this is the put option. Call option is actually change in call option, change in the value of call option. Basically, I'm denoting it by C. And this triangle is actually called as change. So change in the value of call option divided by the change in spot price. I'm just writing it here. Symbolically, it is mentioned as above. What I have mentioned, I'm writing the exact wording there. Change in value of call divided by change in spot price. If there is a change in spot price, what is the change in the value of the call option? Similarly, change in put divided by change in spot. So the change in value of put divided by change in spot price. Now, what does this mean actually? So this is what the literal definition is. Now, see, students, if in the previous example itself, we have seen for the different changes in the different spot prices, the value kept on changing. Now, with what rate the value will change will be given by delta. Simple. Delta will give you that at what rate the change will happen in the value of call if there is a change in the spot price. let's say spot price goes up by 1 rupee, goes down by 1 rupee, then what is the impact on the value of call? Similarly, in case of a put option, if the spot price goes up or down by 1 rupee, then what is the change in the value of put option is going to be created? That is, that extent of change is given by delta. Is given by delta. That extent of change is given by delta. Now, this delta for call option is what? Delta for call option is ND1, which is nothing but the hedge ratio. And delta for put option is equal to minus N minus D1. This is the delta of ND1 and this is the delta of put option. Minus N minus D1. This is the delta of call option, sorry, not ND1. This is the delta of call option and this is the delta of put option. Now this minus N minus D1 is actually coming from the value of put only. See, N minus D1, and this minus sign is also we are taking there. Because there is a reverse impact, correct? Hence, there is a negative sign. Students, please note there is another way to remember this, that because there is a negative correlation, negative relation, correct? Here you have positive relation with the spot price. If the spot price goes up, the value of call option will also go up. If the spot price goes down, the value of call option will also go down. Similarly, in case of a put option, it is negatively related. If the spot price goes up, the value of put option will come down. Similarly, if the spot price goes down, then the value of put option will go up. So there is a negative relation. Hence, negative sign is put here, and N minus D1 is actually the delta or the hedge ratio of put option, correct? So what we are saying here is, if you see delta, in case of a put option, and in case of a call option, so in case of a call option, it is positive. Sorry. In case of a call option, it is positive. Why? Because if the spot price increases, correct? The spot price increases, the value of call option will also increase. If the spot price decreases, the value of call option will also decrease. Okay, students. So the delta of a call option is always positive because it shows the positive relation, as we discussed. On the other hand, delta of a put option is always negative to show the negative relation. Now, how does this negative relation is established? Is if the spot price decreases, the put option will increase. The value of the put option will increase. Similarly, the spot price increases, the value of put will decrease. This is actually called as the negative relation, correct? Wait, let me make the symbols pretty clear. The spot price increase, this will decrease. Spot price decreases, value of put will increase, correct? Now this, since this relationship is established between delta and the value, correct? Now let us go and see what is the next part in delta. Now students, while we were studying on call option from the point of view of buyer of call option, correct? He was the buyer of call option. We have studied one payoff diagram in previous session. Ambika is asking, sir, that means direct relation in call option while in put option inverse relation. That's right, Ambika. Put option has an inverse relation with the spot price, correct? And call option has a direct relation with the spot price. That is okay to say. Now, call option from the perspective of buyer, we said that if here is a price and here is a payoff, then the net payoff diagram will look like this. Initially, it will be negative, and here it will slowly, slightly go rise, and it will then keep on rising because the loss is limited and the gain is unlimited, correct? And this will be the price which is equal to the spot price, sorry, strike price. Sorry. Yeah, so this will be the price which is equal to the strike price plus premium, correct? This is the price here. For call option buyer, we studied this net payoff diagram. This is the net payoff diagram. Now, students, from this only we can see that how the payoffs are changing. Tell me, now from this we are going to derive one very insightful information. Now, if you see here, it was 10, 20, 30, 40, 50, 60, like that, correct? And we have assumed that this is 45 here, in which 40 was the strike price and 5 was the premium. That is what we have earlier discussed. Now, if we go by these details, then just a second. Now, if we go by this detail, then can we say that, okay, let me first also put that till here it is out of the money, and from here it is in the money, correct? Now, in this, would it be right to say till it is out of the money, till the option is out of the money, any change in spot price will not have any impact on the valuation, right? Any change in spot price. Now, let's say the spot price from 10 we have changed to 20. That will mean, just a second. Just a second, students. Yeah. So what I was saying is that in case of an out of the money, till the option is out of the money, what will it mean is that any change in the price, any change in the spot price is not going to impact the value of a call option. Is that right? Yes, because the moment it will become 10 to 20, still the payoff is equal to 0 only, right? And hence the payoff is 0, the value of call will also be 0. 0 or less. Slowly, gradually, it will go up. And finally, once it reaches at the money stage, at the money will make this delta increase from 0 towards 1, and finally here it will be 1. So the delta here it will be 1. Why I'm saying delta here it will be 0? Because any change in the price will not have any significant impact on the value of the call option. Similarly, why we are saying 1 here is because any small change in the price also will bring it deep in the money, and it will have a very drastic impact on the value of the call option. So I'm writing here delta is 0 when the option is starting from out of the money and slightly increases to at the money, slightly increases from 0 to 1 while the option moves from deep out of the money to deep in the money. So this is very critical to understand because when it is deep out of the money, the delta will be 0 because any change in the price will not have any impact. But when it is deep in the money, any small change in the spot price will have a big impact on the payoff, and hence it will have a big impact on the value of the call option. Now, while we say this, can we say that, let me draw this diagram again here. This is there, correct? Can we say that this is nothing but the slope of this line? Because here, if you see, slope is equal to 0, correct? And here, the slope will be somewhere around greater than 0, correct? But less than 1. And finally, once it is deep in the money, the line will actually become like this. So here the slope is equal to 1, correct? So the line will come like this. Slope is equal to 1 means it is a vertical line. Slope is equal to 0 means it is a horizontal line, correct? Namita is saying how drastic impact will come. Please give example. Okay, Namita. So for example, now we can prove actually from the previous question only, where we have seen the different types of spot prices. See, Namita, if I ask you to calculate the delta here, correct? How will you calculate the delta? So first of all, let's calculate the delta here, correct? Delta, how we can calculate? Change in the price, which is 29.60 minus 18.98 divided by 415 minus 398.083, correct? This using this you can calculate delta 415 minus 398.083 and 29.6 minus 18.98. This divided by this multiplied by, it comes as 0.6277. Correct? So the delta, okay, let me plot the values here. So the smallest spot price that we have is 380. And then we have 398. Then we have 415. Okay, this will look like this. And the value of call option is 29.6. 390 is 18.98. And it is 10.52. Okay, students. So now see, I was saying that delta. So now from this change to this change, delta is how much? 0.6277. Now, similarly, can we calculate the delta from this change to this change? Yes. This will be 18.98 minus 10.52 divided by 398.083 minus 380. Correct, Namita? And all the other students? So this is what the delta will be here. If we solve this, it comes as 398.083 minus 380. Let me store this in memory. Then numerator 18.98 minus 10.52 divided by the memory recall into 100. Into 100, if you don't do, it comes as 0.4678. 0.4678. Okay. Now, this is out of the money. Why out of the money? Because what is the strike price? Strike price is 400, correct? This, I am assuming that it is slightly at the money, correct? Because 400, 398, in this example, we are not taking the exact value, but I'm saying it is near or around at the money. At the money approximately, correct? Approx. Because I have to explain this. Even if you take 400 and do this, the answer will be slightly same only, correct? And then this is in the money. Now, if you see, now all of you just see the observation here. The delta from here till here is 0.4678. It would have started from 0 because I said that if it is deep in the money, deep out of the money, deep out of the money is there are very big out of the money gap. I mean, let's say the spot price is around 300. That would be called as deep out of the money. Now, from there, it would have started from 0. And in this bucket, it has reached to 0.4678. Now, slightly, it is going in the money now, correct? Now, the option has started to go in the money. And now, since it is going in the money, do you see the rise from 0 to 1, right? And then finally, once it is deep in the money, it will finally go to 1. So directionally, you see the drastic impact will come here because of this. Now, in the next step, it might be 0.80. Then it might be 0.95. Correct? I hope I am able to give this example and prove this. This is the last question itself. Correct? I hope this understanding is clear. This says that the delta will move from 0 to 1. In case the option is deep out of the money, it will be 0. If it is in the money, it will go from 0 to 1. Ambika is asking, sir, 0 to 1, what does 1 indicates? 1 indicates 1 exactly 1 time. So what does 1 indicate means? If it is 1, that means any change in call option will be exactly equal to the any change in spot price. For example, your spot price changes by 10 rupees. There is a change in spot price. So the change in call option will also be 10 rupees. If it increases, it will also increase. If it decreases, it will also decrease. Simple. So the net change will be equal to the change in the spot price. That is what 1 indicates. Okay. And slowly, gradually, we are moving towards this. I hope, Namita, I am able to give you an example. Okay. So hence, this theory is also proved that it will move from 0 to 1. Correct. So in case of, now let us do it like this. In case of call option, delta increases from 0 to 1 as the stock price increases. Because as the stock price increases, the call option price will also increase, and it will become from out of the money to in the money. And since it is becoming out of the money to in the money, the delta will also increase from 0 to 1. In case of the reverse would be applicable for put option now. Now, see, put option, how can we relate it? Sorry, the spelling is a bit wrong. Delta. Okay. So here we can say that delta increases, actually not increases, but it moves from 0 to -1. Yes, Namita, I have just explained that. Ammika was also asking what is 1. So I explained you that this is the drastic impact, right? This is the drastic means this is the exact same impact. If it is 1, then whatever is the spot price changing, the same change will come in the call as well. Okay, the same change will come in the call as well. So Namita, this is what the same query is. Okay. Yes, so I was here. So I was saying delta moves from 0 to -1 as the stock price decreases. See, now this can be explained with the same thing. Now let's say this is the payoff. This is how it used to look like, correct? Actually, if you ask me, so here the slope is equal to 0 and here the slope is equal to -1 because somewhere it will cross the negative line here like this, correct? We are not going into that, but what the point we are making here is if it is out of the money, the delta will start with 0. Once it is going to in the money, the delta will go to -1 because minus represents the negative correlation, correct? Minus represents the negative correlation, hence it is -1. And also one of the other conclusion that supports this is lower the spot price. Put option would be in the money. If it is in the money, that means the delta will be -1. If it is deep in the money, that means it will become -1. Hence, delta would be -1. Okay. See, students, the main point to be remembered is this actually. Okay. Rest all is just a logical building that we have done, and even the calculation of delta that we have done is just to see whether what we are putting here holds true or not. That is true only, correct? So the call option, we can say that the delta increases from 0 to 1 as the stock price increases. And put option, we can say that delta moves from 0 to -1 as the stock price decreases. Because if the stock price is decreasing, the option will become in the money. Since it is becoming in the money, it will become 1, but negative sign is putting because of the negative relation between the stock price and the change in the between the stock price and the value of put option. Last point in delta is actually the hedge ratio. Correct? This also we have studied. And can we say that is there a relation between put delta and is there a relation between a put delta and call delta? Yes, because both of them put together is equal to 1, right? So put delta is equal to call delta minus 1. These are just a mathematical derivations. So put delta is equal to call delta minus 1 and delta is nothing but the hedge ratio. Namita is saying please explain the put option graph again a bit slowly. Okay. So Namita, I am saying just ignore the graph here because graph is not relevant, but still, if you want, so this is the graph that looks like, right? Initially, when it is deep out of the money, slowly it is like this. And then it will go like this, correct? So here it will be minus 1, here it will be 0, and here it will be 0 to 1. So this is how the put delta is working. Because deep in the money will become once the price is actually going far behind. So what I can say is if the price is 0, basically this line should coincide with the y-axis. Correct? But just to explain, I'm just stretching this here so that you come to know it is deep in the money. Although the price cannot be negative, correct? This is 0 here. The share price cannot be negative. So this line will actually coincide here with y-axis. Okay. Don't focus too much on these graphs. These graphs are just focus on the initial payoff graphs that we have discussed. But just to show you mathematically also that if it is a horizontal line, it is 0. If it is a vertical line, the delta, which is also called as slope, is equal to 1. Okay. Now let us go to gamma. So first Greek is done, which is the delta. Coming to the second Greek, which is gamma. Now what is gamma? Gamma is actually, if you see, it's a bit more complicated in the sense that it measures the rate of change in delta. This is the main thing to be remembered. It measures the rate of change in delta as the underlying spot price changes. Now, students, please note that the delta measures the change in the value of a call or value of a put option in relation to the change in the spot price. But gamma measures the rate of change in delta itself. That is the delta of delta, basically. So gamma is delta of delta, simple. It measures the change in delta for a change in the price. Now, we know that delta also moves, correct? With this two conclusions, conclusion number 1 and 2, we know that delta also changes from 0 to 1 or 0 to minus 1 in case of a call or a put option, correct? So this gamma measures the rate of change in delta itself. We can write that as delta changes with changes in spot price. So even the delta changes with the changes in spot price, correct? Because if it is out of the money, it will be 0. If it is in the money, it will become 1. If it is at the money, it will be slightly 0.5, correct? As the delta changes with the changes in spot price, gamma measures the change in delta with change in spot price. Okay, very easy, very simple. Now, can anyone tell me where will be the gamma highest? See, the delta is actually 0. This is out of the money. Then it slowly, slightly rises, and then it becomes 1. Correct? This is at the money, and this is in the money. Now, the bottom line is that where is the gamma highest? Gamma is actually lowest in out of the money and in the money, because at those point of time there is no changes at all. Correct? Because out of the money delta will be 0, 0, 0, 0. Then it will become slightly 0.1, 0.2. Slowly it will become. But here, drastically it will change again. If it is at the money, I am talking about delta now, not the value of call or value of put. It will become 0.5, and then slowly 1 will become 1, 1, 1, 1, like this. 1 will remain 1 in the money. Correct? So we can say that gamma is always highest because it measures the rate of change in delta. The rate of change in delta is highest at the money, is always highest for at the money options. Okay, deep in the money or deep out the money will have a low gamma. Deep in the money and deep out of the money would have low gamma. Yeah, so Namita, at 1 the gamma will be lowest. Okay, gamma will not be highest. Similarly, at 0 the gamma will be lowest because 1 is not changing, right? 1 is 1, 1, 1, 1 only. And similarly, out of the money 0 is 0, 0, 0, 0.1. It is also not changing. Similarly, Naveen Prakash, it is not in 1. It is not in the money. It is always at the money where the gamma will be highest. And gamma will be lowest if it is deep out of the money and deep in the money. Okay. Namita is asking, sir, we should say put delta is equal to call delta minus 1, as put option delta is negative. Yes, Namita, that is what also we have put. If you see, put delta is equal to call delta minus 1. This is the same formula. Okay. Ambika, gamma will be highest between 0 to 1, but it will be highest at the money. The rate of change in delta will be highest when it is at the money. Okay. So this completes gamma. Now let us come to the third Greek, which is Vega. Now, what is Vega is? Vega is actually, it measures the sensitivity of option. Now, as I told you that there are 4 factors that affects. One is the spot price. For spot price, delta we have already studied. Second one is the gamma itself, which measures the rate of change in the delta itself. Then third one is Vega. Vega is actually sensitivity of option price to the changes in volatility, which is the standard deviation, correct? Which is the V that we are using. Higher the volatility. Now, all of you can only tell because we have already discussed this. Higher volatility will mean higher D1. Higher D1 will mean higher ND1, and higher ND1 will mean value of call will also be higher. Sorry, correct. So the value of call will be higher in case that D1 is higher because of higher volatility. So it have a positive relation. Okay, Ambika and Namita, both of you are asking how gamma is highest at the money. Okay, let me go back and explain that again. So what is gamma first of all? Okay, so we have completed Vega. That's all about Vega. I'm now again coming back to gamma just to explain. This is gamma to explain. Okay. Now, as we have seen that what is gamma? Gamma is the change in delta divided by change in spot price. Now we know that delta is what? Delta. So this is gamma and this is delta. Okay. Delta is change in value of call option divided by change in spot price. Okay. Now it is clear. Now delta changes from 0 to 1. Correct. Delta is not a constant number. It will keep on changing as the spot price changes. That we have already seen while going through the delta definition. So 0, it will be out of the money, deep out of the money, I can say. And 1, it will be deep in the money. Okay, students? And it will be here somewhere at the money. Now, if you see, if it is deep out of the money, the change will have a very high impact on a, sorry, we are not talking about here the change of spot price, that it will impact the change in value of call option. What we are talking about is what this change in spot price will bring a change to delta. What we are saying is that still 0 will be 0 only here. It will change slowly. Let's say 0 will become 0.1, 0.2, 0.3. But as the price is moving up, suddenly it will become 0.5 here. Then again, it will be, the change in delta will be higher at the money. But again, once it is going to this, to near deep in the money, it will be 1 only. So 1 will not change now, correct? Hence, gamma will be 0 here. Gamma will be 0 because 1 is not going to change. But gamma here will be very high as delta is changing rapidly. Okay, Ambika and Namita, please go through the entire thing that we have discussed and just try to think it that we are talking about the change in delta here, not the change in call option or a put option. Because the change in call option and put option we have covered in delta. But gamma, we are covering the change in delta itself. Okay. So the delta will move very fast when it is at the money. See, quickly it has gone from like this 0 to almost 0.45 or 0.5. Then it has quickly gone to 1. Now, after reaching 1, delta is not going to change. And starting from 0, it is slowly increasing. Okay. So don't get confused. Gamma is just for the, sorry. Yeah. So what I was discussing is this gamma is just measuring the rate of change in delta. That's all. Okay. Vega we have considered. Now the last two are rho. Rho is actually the sensitivity of an option price to the changes in the risk-free rate. Sensitivity of option price to changes in the risk-free rate. Now, what happens here is call option. Now, with the formula itself, we can understand that what impacts does it create. If the rate percentage it increases, the call option will also increase and the put option will decrease. Similarly, if the rate decreases, the call option will decrease and the put option will increase. This we can simply check it from the option formulas itself. So what it is, ND1 minus x raised to the power ERT multiplied by ND2. This is the value of call. Value of put was x divided by ERT n minus D2 minus Sn minus D1. This was the formula, correct? Now, if you see, R is placed here. Higher the R, higher will be the discounting and lesser will be this value. Lesser this value, higher will be the value of call option. Because lesser value will get reduced from the entire formula, correct? Similarly, in case of a put option, if the higher rate of interest will mean that this first equation will be lesser, correct? This first part of the equation will be lesser. If it is lesser, that means entire value of put will also be lesser, correct? Okay. So both call option and put option are related to the rate, but in such a manner that call option is positively related and put option is negatively related. Now, coming to the last point, which is theta. This is called as theta. Theta is actually related to the passage of time. Sensitivity of option prices with the passage of time. Now, this is very simple. As the time decays, the time value of money will also narrow down, correct? The gap between future value and present value will be lesser, and hence the option prices will also come down. So there is nothing big to understand in this. The theta, there is a very perfect relation. That is, the option prices with the passage of time, the gap between the future value and present value will come down, correct? And hence the option value will also coming down. So these are what 5 Greeks are. Okay, what are those 5 Greeks? The first one is delta. As we have mentioned here, just a second. See, this is actually delta, correct? Time is equal to theta. Rate of return is equal to rho, and volatility is equal to Vega. These are the 4 that we have studied. Apart from this, we have also studied gamma, which measures the change in delta itself. So this is delta of delta. And all these 4 plus 5 gamma are derived from the Black-Scholes model only, because in that we are using all of these as a factor to compute the value. Okay. Now, the last part that is left is the embedded derivatives. Just a second. Let me just, yeah. Yes. So now the last part from the understanding point of view left is, no, Namita. So very good question from Namita. Actually, that is a basic thing. At expiry, will option price also equal to the spot price? No. See, what is option price? Option price is actually the premium, right? Premium will never be equal to the spot price because premium is derived from the spot price. But in futures, the entire future value is also derived from the spot price, but it is 100% we are doing just the future value and present value there. But in case of premium, there is an element called strike price also, correct? So this strike price is constant, and premium is the difference between the strike price and the spot price on expiry, correct? So hence it will not be there. Okay. Now the last part is embedded derivative. This also we have to just understand from the theory point of view. So what is embedded derivative? Now embedded derivatives means, let us understand it from these two boxes simply. So there is a outer box. This I am just naming it A here. Okay, let me name it as B here, and I am just naming the internal box as A. Now there is a outer box which is called as a host contract. Is a host contract. Within that contract, there is a embedded derivative. There is a hidden derivative. Embedded means that is embedded there, correct? Which is called as A here. Now it is part and parcel of the host contract. What happens is host contract is just a regular transaction, let's say of any sale, of any purchase, of anything that you can imagine, of any rent, for example. That is just a normal transaction. But what happens is if we go and account this normal transaction as it is, then we are ignoring the derivatives quality of that contract. That means because derivatives are always price sensitive, the prices will go up or down based on the price sensitivity, and hence we will be ignoring the mark to market logics, also other things as well while accounting, because in accounting, if there is mark to market, then we have to do the fair valuation through profit and loss, correct? So in that case, now there is a proper guideline that have been issued to us. Now what does this guideline says that in case, now I'm just writing what is the background of this this thing, because if there is a derivative, it has to be accounted as fair value through P&L, correct? If we just go in and account this host contract as is, then we will ignore this part. Now, what to make a possibility that we are not ignoring this? So for that, we have to run through this test. What is this test? Now, first of all, we have to see that is the contract. We are talking about host contract here, correct? Is the contract carried at fair value through P&L? If we are already carrying the contract at... Yes, sir.
Sorry to disturb you.
Yes, sir.
I want to ask, is that what is you are making your student understand about the embedded derivative? Is it related to IFRS, or you can say accounting standards?
Yes, sir. Yes, sir. It is definitely related to accounting standards.
Okay, I think we need to because it is already covered in their accounting paper.
Sure,
so
sir.
I think you can avoid the same.
Sure, sir. Sure, sir. Okay, sir.
Okay, because it is a paper is of our because it is a paper of our SFM.
The SFM,
so,
yes.
And this embedded derivative is covered there. So
sure.
Because in this edition also we are coming out with a new edition, we have removed this embedded derivatives.
Sure, sir. Sure, sir.
So you can.
So we can skip this. Yes, sir. Yes.
You can skip this.
Better. Topic. Yes, better students can cover this topic in paper number 1. Correct.
Yeah, because it will be well covered there.
Sure, sir.
And any other topic has been left?
No, sir. Then apart from this, there is some theory in the commodity derivatives, but that is very much.
That you continue.
Yes, sir. Yes, sir.
Okay.
Yes,
okay.
Sir. Sure, sir. Yeah. So, okay, students. So, as discussed now, we will go directly to the theory part in the commodity derivatives. Okay. We will just skip this part. So, the commodity, sorry. So, in case of the commodity derivatives, now let us go through the commodity derivatives once. Now, in the So in the first session of derivatives, we studied that there can be different types of underlying, correct? What were those? Equity share, index, and then it was commodity also in one of the cases we mentioned, and there is a forex also. These four types of indexes we said. Now this commodity, there was one question also that we have studied, that we have also solved. That commodity question was for the rice trader, if you remember, correct? Now what are these commodity derivatives? So as the name suggests, commodity derivatives have underlying as commodity. So the underlying security or the underlying asset is always the commodity itself. Now, once it is the commodity itself, that means what would be the uses of this? So the biggest use for this goes to the actually farmers, because the farmers will produce the stock and keep it with them. And once it is produced and kept, they will definitely want to sell, or they would want to protect themselves from the price increases or decreases. Or let's say once the farmer is planning to produce also at the time of sowing the seed, so he would know that okay, after 6 months, after 6 months I will get this much of produce from my farm. Now how to protect myself from the prices going up or down during that point of time? So he will use the commodity derivatives as a technique to protect himself, to hedge himself against the risk of prices going down, because farmer is carrying a risk of price going down. He has to sell. So what he can do is, in commodity also, there are all these three things: forwards, futures, and options. Correct? All the three things are there. So all the concepts that we have studied on valuation, everything will sacrosanctly applied here. Correct? But for a farmer, typically, he would enter into a forward kind of a contract in which he will lock the price today only. Lock the price today. Correct? This is what the forward contract means. And using that price, he will go ahead and do the transaction after 6 months. So basically, just to give an overview on commodity derivatives simply will include the underlying as a commodity, and the main users of these commodity derivatives are actually farmers. Correct? Now, this is what it is. But there are some preconditions for, what are the different types of commodities that can be traded in terms of derivative? Do we have a limit there? Yes, we have some preconditions which needs to be fulfilled before a commodity derivative can be designed for a commodity. Now, what are those conditions? First of all, the commodity should be durable and it should be possible to store it. So commodity should have durability and storability. If the commodity is not durable at all, or if the commodity cannot be stored, then who is actually going to use the commodity derivative? That itself gives the answer. Correct? So it has to be durable and it has to be storable. Second is, the units should be homogeneous. Definitely, this is also a prerequisite. If the units are not homogeneous, that means all the units should be same. For example, sugar. Sugar is 1 kg, 1 kg, 1 kg. The unit can be homogeneous. For example, now 55 kg, we can enter into 55 such contracts. Correct? The unit has to be homogeneous. Now, for example, you have iron. So iron should be in kgs, right? So all these things should be having a unit as a homogeneity. And the biggest factor is the price fluctuations. So what is this price fluctuation? The commodity should be of such a nature that price fluctuation is visible. So there are higher price fluctuations, because if there are very less price fluctuations, then no one would be interested to go for a commodity derivative, because they will say that, okay, in open market also, there is no too much of price fluctuation. we can simply go ahead with the normal open market. There is no need to go ahead and do the derivatives there. So the basic need that creates the birth of commodity derivative is definitely the price fluctuation. And the fourth part, the supply should not be controlled by someone. Supply of that commodity should happen automatically in the market, and there should be a use of forward contracting. Okay, so basically these are some of the prerequisites before which the commodity derivative can be given a birth. I mean, the commodity derivative to have these four conditions should be there. So these are very much given in our study material. I request all of you to go through that. And mostly we know that the main users of these commodity derivatives are definitely the farmers. Correct. So, and within these, we have different types of commodity derivatives now. For example, we have commodity futures, we have commodity forwards, correct? And that's majorly around the commodity derivatives. I request all of you to please go through the theoretical part that is also given in the study material to strengthen your understanding. But the basic concepts remain same here. So I think with this, we have completed the entire topic on derivatives, valuation, and other things. The rest of the things will be covered in the future session. Thank you, sir, for giving me the opportunity to take this session. And with this, I conclude the session. Thank you, sir.
Thank you, Divas. Thanks a lot. And your session was very good. And in fact, you have covered the derivative in a very good manner. Now, student, before we wind up this topic of derivative, I would like to highlight 2 or 3 points. In this class, session, 4 to 5 sessions, you have understood. Basically, we have covered the derivatives. Basically, here the underlying was stock or index. But please remember, the same concept will be used in foreign exchange risk management. There, the derivative technique will be used, but the underlying will be basically the your foreign exchange. So please remember, in that class, we won't repeat all this concept that is forward contract, future contract. There, we will assume that you have full knowledge of the same. There we will we shall proceed directly to the applying these hedging techniques for the mitigating the risk. And another query one student has asked, sir, can you circulate uploading the handwritten notes? Student, in this regard, I would like to mention that we normally encourage the student to go through the class again and again, because these are freely available on YouTube, and even you can ICAI YouTube channel. You can watch and prepare your own notes, because what happens whenever any faculty teaches, he may use any reference of any study material, any other book, etc. So it may also be possible that we may have to face the IPR infringement case also. So that's why normally we say, of course, whatever be the PPT, etc. available, that will be uploaded. But in case of Divas sir, normally Divas sir discuss everything on the iPad only. So my request to you, please prepare your own small notes, and study material is there, because sir has used the study material as their basis. And for additional notes, you can prepare at your own notes. So that may be quite impossible for us to upload all the handwritten notes. And third point, as I have discussed, embedded derivatives has been covered in your IFRS paper, so it is no more here in your SFM paper, because we are coming out with a new edition that is applicable to you. So there the embedded derivative has been skipped. Okay, students, thanks for your patience listening. And now in the next session, we will start with the foreign exchange risk management. Like derivative is also a very important topic for your examination point of view, as well as practical point of view, because normally nowadays economy has become globalized. So this topic is also very important, and CA Sushant Arora will take up this session. So see you there, and thank you Divas for your efforts for making this this is typical topic of derivatives in a very lucid manner for the students. Thanks a lot.
Thank you, sir. Thank you, sir.
Okay, students, have a nice day. Have a nice. Thank you.
Yeah. Thank you.